Matt said, I'm going to talk a bit about macro, a bit about the portfolio. I've got some stocks I'd love to talk to you about, and you can ask me questions and take it anywhere. So maybe let's start with what the real big problem, which is essentially still inflation. So I've got a couple of charts on this that I think are very pertinent. The middle chart is really probably the most pertinent. What I've plotted there is in the US, the ratio on the gray line, the ratio of the number of job openings to the number of unemployed people. So when you have a situation where you have a lot of job openings and very few unemployed people, you have an extremely tight labor market. And everybody that is employed essentially realizes that they can raise the price of their labor, and you get wage inflation. And wage inflation is plotted there in the red. So you've got record low unemployment, record tight labor market, wage growth growing between 4 and 5%. Now, wage growth growing between 4 and 5% is not compatible with an inflation target of 2%, because the process that happens in the economy is essentially when wages rise, companies, in order to maintain their margins, tend to raise prices, and then you get a spiral, because as prices go up, people go to the employers and say, I need more money. And then you're stuck in an inflationary spiral. So the Fed's trying to kill that, which is why they've increased interest rates so much. So the problem is that the labor market still is extremely tight. And if you look at recent measures of the labor market, things like the number of jobs created each month, so the payrolls report that comes out of the US, that's still running extremely high. So we had 2 months ago, we had a print of 500,000 jobs created. A month ago, we had a print of 300,000 jobs created. Around 100,000 is a reasonable level for a steady state environment. Obviously, it drops way down when you have a recession, but the US is still creating a lot of jobs. The other measure that's very important, which is part of that gray line that I'm showing there, is the number of job openings, so the number of adverts for jobs, and that's at absolute record highs. So companies have been shocked by the COVID experience. They're worried about labor supply, and so they're hunting for people regardless of concerns about a slowing economy. They're still looking to hire, so they're labor hoarding. So that, and then we get a weekly number of initial jobless claims, which is people that get fired, and that number is running very low at around 200,000. So all of the indicators that we get out of the labor market are telling us that wages are growing too fast and it's too tight. And that's why the Federal Reserve continue to raise rates, even though we've had a bit of turmoil in the last few weeks, because it's gunning for breaking the labor market. The issue is that can be a long process. So we may have to wait 6 months, 9 months. We just don't know how long it's going to take for the labor market to loosen. One of the issues that extends that period of loosening is the fact that we've gone into this very, very strong. So households were not very levered. They didn't have a lot of debt pre-COVID. Actually, COVID allowed them to save a huge amount of money. So not going out to restaurants, not having to buy fancy clothes, to go out, not traveling, not going to work. All of that allowed people to save. And then in the US in particular, they got very big checks from the government twice. So they literally were sent a check in the mail. So that basically pushed cash buffers in people's hands up a lot. So we've still got a situation where very many people have cash reserves and are still spending those cash reserves. And that bolsters the whole economy, keeps employment up, which makes it harder to get rid of the tightness. So we're still in that process. You can kind of see the result of this. So the chart on the left is a measure of a core personal consumption expenditure inflation. That's the key measure that the Federal Reserve uses to assess the level of inflation, and it's what it targets when it tries to get to 2%. That's the number it targets. So if you look at the red line, I've just plotted 2 points. So the peak of that was 5.42, and we're still at 4.73. So almost double the targeted rate. And it's come down a little bit over time, but not very much. If you split out the components of it, there are 2 major components. The one is goods inflation, which I plotted in the light blue line. And the other one is services inflation, which is in the black dotted line. You can see that goods inflation went up a lot as we had supply chain bottlenecks. And as everybody stayed at home and redid their houses and bought goods, essentially, instead of services. And then that's come off as supply chains in the world have cleared. The problem is, as I mentioned earlier, the services component, which is driven by wages, is still very high. So we're still stuck in this. So that's the core problem that we're in. We're heading into a slowdown, trying to get inflation down. So as an equity investor, the 2 things you've got to think about when investing in equities is, what is the baseline outcome for what companies will deliver in terms of earnings growth going forward, and what am I paying for that earnings growth? So what I've put up over here, there's quite a lot of data, but there are just a few data points that really matter. Is if you look at the first column, I've put a box around it and a big red arrow. You can see on the top, you can see the expected earnings growth in each calendar year. So for example, in 2023, right on the top left, we're expecting the market's currently expecting earnings growth of 1.1%. And in 2024, the market's expecting growth of 11.9%. Those are very high rates of growth if you're thinking about a slowdown in the economy. What tends to happen in recessions and slowdowns is you get negative earnings growth. Now, those numbers have come down. So for example, the 2023 earnings numbers come down around 10% in the last 12 months. So we're on a glide path downwards, but we have nowhere near got to the point where we've bottomed. And you can see some of that on the chart, the line chart on the bottom right, which is a projection of earnings expectations 12 months ahead. So you can see that we've barely broken the peak. We peaked out at 41.96 and we're only at 39.94. So that's a tiny move down. So the problem with this is that knowing what's happening and knowing what's coming, when you look at it as an investor, well, I look at it as an investor, I just see an overly optimistic equity market in terms of earnings. People are basically assuming we won't have very much of a recession. And that's something that almost never happens when you raise interest rates as fast as we've raised them. It's highly unusual to get a soft landing. You usually get quite a hard landing. And we've seen signs of why that happens. So, the last 2 weeks with the banks, and we can go into that in a bit more depth, when you get a shock, you get shocks, you get things breaking when you move interest rates too quickly, which is why we've had some bank failures. So the odds of us escaping in a soft way out of this are very low, in my view. So the next thing I said that matters in terms of thinking about investing in equities is what price you pay, right? Because you can actually have a situation where even though you think earnings might come down, if you pay a really low price for the equities, it still might be a good investment, right? But the problem is that at the moment, you're still paying quite high multiples for equities. So one of the classic ways of thinking about valuation in equities is comparing it to bonds. So you can look at what return I'm getting on it. Let's say, for example, the US 30-year Treasury, what yield am I getting on that? And you can say, you can back out what return premium you're getting over bonds in owning equities. In general, through time, you usually get about a 5.7% premium to owning bonds. And that's the reward of taking the risk of owning equities in general. At the moment, the way the market's priced is you're only getting about a 4.5% premium, which is too low relative to the long run average. So what that tells you, and then that's also that number of 4.5 is a function of today's earnings as well. So it would actually be lower if earnings were more reflective of a slowdown. You'd actually be getting a lower implied return. So as an investor, I look at it and I think the rational decision from a risk reward perspective is to be quite cautious in terms of equity allocation. I wouldn't say own nothing. If you have a baseline allocation, you want to kind of be neutral to underweight in the near term and rather allocate capital to shorter term bonds because you're getting very good yields, even in very short maturity bonds. For example, in the US, you can still pick up 4% risk-free, essentially, at this point. And that's also on the view that as we go through the slowdown, the monetary authorities are going to drop interest rates to put a floor under the slowdown. And those interest rates will come down and you'll get capital appreciation on your bonds. So this kind of environment for the next short while is more favorable from a risk-reward perspective in bonds over equities, in my view. That will change as we move through the year. So once we start getting the Fed talking about cutting, people will understand that we're at an inflection point and the equity market will probably find a bid. It'll start finding buyers coming in a significant way. So that'll only come when we start seeing unemployment tick up and the Fed starting to respond to the slowdown that'll start emerging when that happens. And as I said, the timing of that is uncertain, but it's probably later on in the year. When you look at how the market's pricing, so the market's taking a guess every single day as to when that would happen, when that was going to happen. Pre the financial issues that we had in the last 2 weeks, the market was basically saying that it didn't expect this to happen by September. September was the first point where prices for bonds started to reflect a reduction in interest rates. Given what's happened in the last few weeks, that's been brought forward. So the market's now expecting the Fed funds rate to stop where they lifted it last night and to stay there until the middle of the year. And then by July, starting to be cut, because the banking crisis has accelerated the slowdown process, because banks essentially have been starved of deposits because of people moving deposits away from the smaller banks and actually buying bonds, looking at bond yields and saying, I'd rather have my money in high quality, low risk, short-term bonds or money market funds. I don't need to keep it in the banks. And that's basically led to deposit flight from the banks. And that deposit flight causes banks to slow down their lending growth. And as they slow down their lending growth, that slows the economy. So that's why the slowdown has been brought forward by what's happened in the banking sector. It may also make the recession deeper, because when you have less credit flowing through the economy, it's another weight that slows things down. So that's the macro view. So essentially, to sum it up, we're heading into a slowdown. Take less risk in the short term. Think about re-risking as we get to the end of the year. And that's the strategy that I've got in terms of how I'm managing capital in the fund. So I have a choice when I'm thinking about global equities to invest in either companies that are cyclical, that do well when things do well and do poorly when things do badly, or buy very stable businesses. So at the moment, most of the capital in the fund is concentrated into less cyclical companies. So companies in the healthcare sector, companies in the consumer staples sector, where demand stays fairly constant even in recessions. So that because I'm aware of the earnings risks that's out there, and I want to minimize the exposure to that earnings risk, and have less concentration in names that are cyclical. So the portfolio is essentially deployed defensively. So as I think we move through this year from a portfolio management strategy perspective, I think there are two things that I'm thinking about. One is, I don't think the recession we're going to get is going to be dire. I think it's going to be a mild slowdown, certainly in comparison to what we've experienced in the last 20 years. We're not going to have I believe we're not going to have a financial crisis, and I can tell you about that as well. I think we're going to have a mild cyclical recession that will be investable. You can buy the lower equity market, knowing that the stimulus will probably put a bottom in the growth, and we'll have a recovery. So what I'm looking to do as we move through the year is move money out of the safer companies into the more cyclical companies when they offer very good, attractive valuations, which I believe will emerge as we move through this process. Now, let me tell you a little bit about my product. So essentially, the way we run money is we invest globally in 50 to 70 companies. And the whole philosophy behind the product is to find the best businesses in the world, buy them when they're attractively valued, and then construct a very well risk-managed portfolio of them. And then produce excess returns over the market over a 3-year horizon, and do that with less risk than average. So that's the core philosophy. So, we look for companies with very particular properties. So there's a particular economic process that we know delivers extremely good long-term results. And that process is essentially a process of compounding. And what that means is essentially this. You get businesses that are so strong and so profitable that for every $100 you put in them, they generate you $15 or $20 every year in return. So 15 or 20, 25% return on invested capital. If they're able to maintain those returns and redeploy the cash every year into new growth projects, you can get that 15 or 20% return over time. In order for that to happen, they have to be run by really good people who understand how to protect the business and take advantage of the opportunities. And then you get a compounding process like this, a multi-year compounding process inside the business. If you deploy your capital into these sorts of things over the long term, you can get very, very high rates of return over time in relatively safe businesses. And in general, the market doesn't fully price the quality of these businesses, especially if you own them over the long term. We have a very, very disciplined process in doing this. One of the things that differentiates our product from other people is that we have a due diligence process where we look at each element of cash flow, sustainability, growth, and management, and we score every business. So globally, we look at about 300 businesses at any point in time. We rank them, so we know what's good and what's not. We debate them within the team. We calibrate our view on quality in a holistic way across all of them. We have 120 that we follow very, very closely, as if we were invested in all of them, and we own 65 at the moment. So we run a bench. It's almost like a football team. We have 65 on the field playing, the game that we think is currently being played. For example, now we're getting into a slowdown, so we have more defensiveness. And then we have another 60 on the bench that we can put into the portfolio really quickly as conditions change. That's our style of management. So this is the portfolio. So I can go through the names. I've got a few examples that I'll talk you through, but just to give you a sense of the companies we own, many of them you'll probably recognize. I've grouped them thematically. So we have a few things that drive them long run that are similar. So for example, one of the biggest things happening in the world is really everything's digitizing. So, more computers are moving to the cloud. People are using faster chips. People are starting to use AI to solve problems. There's lots and lots of development and growth in digital. That's spurring the demand for semiconductors, cloud software providers, companies like Amazon, NVIDIA, ASML. And then there's obviously software, there's digital payments. More people are using digital payments versus using cash. And then more and more financial infrastructure is becoming digital. So they're great companies in that sort of bucket. The next big bucket is healthcare revolution, which is essentially driven by aging populations in the world. And as tech is becoming more and more used in research, you're getting more and more innovative drugs that are, very, very attractive solutions for people's medical problems. So there's tons of opportunity there. I mean, we even own businesses that are involved, for example, in pet care. So doing diagnostics with pets. So if you bring your dog into the vet and it's got a problem, you can't talk to the dog doesn't tell you what's going on. So you've got to, run a whole bunch of diagnostics on it to work out what the issue is. And we own a business called IDEX that does that. Really great business.
Can you touch on Ferrari and Tesla?
Yeah, I mean, we also own businesses that benefit from people's rising incomes in the world. So we really like businesses with pricing power. So Ferrari is an example of that. So Ferrari is an amazing business in that you can't really walk into a shop and buy a Ferrari. They won't sell one to you. You have to be somebody who's originally bought a secondhand Ferrari, and they know where all the secondhand Ferraris are. There are only 250,000 Ferraris in the world, and they only produce 10,000 a year. So they know everybody who owns every Ferrari. And if you want to buy a really good model, you have to have owned one. And if you don't own one, you might have to wait 2 years to buy one. So they've been able, through their brand and technology, to create a car that it is in where there's the demand way outstrips the supply, and they manage the brand and the supply so well that they're able to sell these cars at incredibly good margins, and they never run out of demand. So if a recession happens and there are a few people drop off their waiting list, it doesn't really matter. They can still sell to that waiting list that's waiting there for 2 years. It's an incredibly resilient, high growth, highly profitable business, an absolutely unique asset. To recreate Ferrari would cost absolute billions in terms of brand building and absolute billions in terms of technology. You just can't do it. So, I mean, that's an example. I mean, Tesla is a very different animal. We own a very small position in that. Obviously, Tesla produces electric vehicles. That is the wave of the future in terms of transportation. They have the best electric vehicle out there in terms of hardware and technology integration. And they are the lowest cost producers of these electric vehicles. They make double the margin of BMW, even at much smaller scale than BMW. They have 1% of the global market. And we think by the time the other vehicle manufacturers have caught up to them, Tesla may go from 1% of the market to 10% of the market. And if that happens with a business, it's a 10-bagger. Your revenue goes up 10x. The stock can go up 10 times. So that's a very high growth business. It's controversial. It's run by a guy that some people love and some people hate. But you can't build a brand from zero that quickly if you're not somebody that gets in people's faces, and that's what he does. And Tesla's benefited from both his engineering expertise and his persona. So that's a business we really like as well. So that's just giving you a flavor. Maybe I'll skip to a few more examples, just a few more. So another business we own is a business called Queiqiao Maotai, which is a Chinese business. So this fund is completely global. It's one of the things that differentiates it. We can invest anywhere, and we do have quite a few investments in China. Maotai is an incredibly interesting business. It sells a spirit called Baijiu, which is made from sorghum, and it's a bottle of Baijiu costs about $500 a bottle, US dollars a bottle, and it can range up to $1,500 or even higher than that. in terms of its cost. So it is a product that is used in China in building relationships. It's a gift that people give one another to signify connection and respect. And it's used in business meetings, in politics. It's very much part of the culture. And this is this brand is extremely unique. It's produced in one part of the country. It's also similar to Ferrari. It's got incredibly good recognition. They make 70% operating margins. So, for every dollar, they keep 70 cents, which is an incredibly profitable business. And it's growing at 15% a year. So it's incredibly difficult to disrupt. And there's a long runway for growth. And, and it's actually quite stable because it's a consumer staple business. So that's, for us, a very, very interesting Chinese business. It's simple to understand. It's a simple product. And it's just super well positioned to benefit from China's rise structurally. Another one, I'm going to talk about 4, so bear with me. I think they're all interesting. Another business we own is called Keyence, which is a Japanese automation business. Essentially, what they produce is high-end, high-speed cameras, along with software that sit on production lines and assess the quality of parts moving down the production line. So if you are an auto manufacturer or an electronics component manufacturer, instead of having a person check quality, you'll have a machine. And that essentially massively saves on labor costs for companies, particularly as companies start moving production out of lower cost countries like China back into the West, and as well as when we exist in an economy which has a shrinking labor force over time. So the people need to automate in order to be efficient, and Keyence is the world leader in factory automation and imaging technology in Japan, with a huge runway ahead of it. It makes 50% operating margin, so extremely profitable. It's cyclical, but it's an incredibly good business. 2 more. Trex, completely different to the other 2. So this is a US business. It produces composite flooring, or wooden flooring that you'd use to build an outdoor deck. So the US mostly have wooden houses. They have larger properties, and a lot of them build decks on the outside. And those decks are usually made from wood, which have a limited lifespan because they usually get eaten by termites or they get hit by the sun. So Trex uses recycled plastic to produce basically the exact same thing as wood, looks exactly the same thing, looks exactly like wood, feels like wood, except has a very, very long lifespan. So the total cost of ownership for building a deck with us is much lower than putting in wood. The US has too few houses relative to the number of people there. People are staying at home, redoing their houses because they work from home more. So they want, a nicer space at home. So there's an incredible runway of growth as people move from wood to composite and redo their houses. So another great business we own in the US. Last one, completely different as well. It's a payments company. So this is a business called Wise, listed in London. Essentially, the market for FX transfers, so moving money from one currency to the next, has been done by banks. They charge exorbitant fees, around 6% sometimes, to do an FX transfer. Embedded, it's a very hidden fee, but it's there. Wise has set up, so the reason they charge you this amount is because they have to talk to all the correspondent banks. There's a correspondent banking system across borders. And at each layer, there's a fee charged by the bank. And all of this brings you to 6%. And sometimes it could take 1 or 2 days for this to happen. What Wise has done is establish independent pools of deposits. And it does a match, it does a swap. So instead of sending the money across the border, it says, you're a European wanting to send money to your friend in the US, and there's a US guy wanting to send their money to Europe. Let's just match you. And they do an asset swap, and the fee is 10 times lower than the banks, and it happens instantly. So the market for this is absolutely enormous. It's a $200 billion fee market globally. Wise has less than $1 billion in revenue. And so the runway for disrupting the banks and taking share is enormous. The business grows 20% a year, and it makes 20% operating margins. And the margin is only likely to go up over time. So just incredibly different global businesses. I'm trying to give you a flavor of the kind of thing we look at home. So maybe let me just go back to one last thing and then I'll stop for questions. So why would you even think about owning a product now? I've just told you equities are risky, and I've given you a whole bunch of great ideas. So I'll say this: the style of company we own are higher growth, higher quality. And what happens is, when interest rates start to peak and fall, growth stocks tend to do better than value stocks, because more of their cash flows further into the future. They're very similar to longer duration bonds. And so as interest rates fall, growth stocks go up. We saw the reverse of that happen in 2022, where growth stocks were hit very hard with a spike in inflation and interest rates. And we think that's turning from a headwind to a tailwind as we move forward. And the second thing is when you're in a slowdown, higher quality earnings really matter. So are you very profitable? Do you have less cyclical demand? Do you have a very robust balance sheet? All of those qualities are the kind of qualities that these businesses that I'm talking about have, and they tend to do better in that environment. So never mind the long-term structural compounding potential for these businesses, just near term, it makes more sense if you're going to have an equity allocation, which most people do, and one should do through the cycle, to allocate to quality growth at this point in time. So let me stop there. I've said a lot. I'm happy to take questions and discuss anything really.
And take questions online as well. So please, please go ahead and ask.
Yeah.
So in terms of, it does feel obviously a bit of a negative tone initially, but then obviously some pretty good numbers that are suggesting towards next year's growth for earnings. So in terms of the timing around that, given the market forward looking, suggests as though the next kind of 3 or 4 months will be definitely a buying of the dips for these types of businesses in preparation for that time.
Yeah,
that'd be right in what you're saying.
I would say that it's these businesses will do relatively better than other businesses going forward, because I think the cyclical businesses are still too expensive and the earnings expectations for them are still too high. So if you were going to allocate within equity, I think owning quality growth businesses will produce better near-term returns as we go ahead. Once we've gone through the recession, then cyclicals will become more interesting again. But I think that might only be at the end of the year. So we're talking about allocation within equities. If I had to talk about allocation to equities, I would say that the signal for starting to add to your equity allocation will be when we actually see unemployment start going up. Now that's kind of counterintuitive, because you say, well, that's bad news. No, but that's the point where people will get interested in again. Because what will happen is we'll probably get a very big response from the Fed. As long as inflation's headed downwards, they'll start cutting rates, because they'll know that unemployment's on the way up. They don't wait for unemployment to get to 5 or 6% before they cut rates. They start cutting rates the minute they see a big sign of unemployment ticking up. And as they do that, that will induce buyers into the equity market. And people will start buying the equity market, and counterintuitively, the equity market will go up as earnings go down, because people will be looking through the recession and saying, this is the first time when you can start taking risk. Now is a very dangerous time to take risk, because we still don't know how long we'll have to have high interest rates. We don't even know if we've hit the peak of interest rates yet, because we still got an inflation problem. So the risks are high now, and they reduce as you've gotten out of the inflation problem and you get monetary stimulus. So the buy the dips happens when you get stimulus, but the swing to quality should happen before that happens, in my view. So you protect yourself internal to the market.
And you noted before having shorter duration, like you had mentioned, 4-year kind of fixed income.
Yeah.
With the direction of interest rates and what is going on, wouldn't that suggest extending it, even more duration around that type of asset class?
Yeah, I mean, I think taking duration risk now makes sense, because you're getting to the top of the interest rate cycle. So the odds of losing money on longer duration assets diminishes as you get to the top, right? So the Fed last night said they raised 25, and then they kind of said, we're going to wait and see. It was the first pause, let's say, language that they used. So I think we're kind of there. So adding duration now is much safer than it was 6 months ago, because 6 months ago we didn't know whether we'd top out at 5% interest rates or 6 or 7, and now we're much more certain that it's around 5.
So has the turmoil from the US regional banks now changed the Fed futures outlook on cutting, and how's that playing out?
Yeah, so let's talk about that, because obviously that's a big worry for everybody, because everybody has memories of the global financial crisis. And the minute you hear a bank failure, you think, oh my God, are we going to go through the same thing again? And I think the thing to understand is two things. One is we've had an enormously fast and substantial response by the authorities. So the GFC started developing in 2007, and it took about a year for Lehman to go bust and for them to come in and underwrite things. This has happened within a week. So what they've done essentially is they've provided credit lines to the regional banks and almost any bank in the US, and basically said, if your deposits are leaving, doesn't matter, you can get funding from us directly. You can pledge some bonds at par and get funding. That means that the liquidity in the system is underwritten, first of all. There's two things that bring down banks. One is liquidity problems, and the second thing is solvency problems. Now, in 2007, the solvency problem was housing, because we had misallocation of capital to housing. We had people lever up and buy houses at way too higher prices. And then as those prices started dropping, that started blowing up bank balance sheets and preventing them from continuing to provide financing for housing. And that accelerates the process, because if there's no financing for houses, there are no buyers, prices keep dropping. Now, when you have that happen, that's a far bigger problem than what we've got today. Because today, the banks that have folded, the assets that have hurt them have been treasuries. They went and bought treasuries at 1% in 2021 with deposits. And those treasuries have fallen as interest rates have risen. Now, the instant thing that happens when the banking crisis hit is that treasury yields went down. So the value of the collateral went up. So it's not a self-reinforcing process. It's a self-correcting process, right? So from a solvency perspective, they're not, we're not in a downward spiral. We're in something that can be stopped quite quickly. So I don't think the whole thing is as dangerous as it was, in 2007, 2008. There are dangers out there, but they're not in the banking system. Because there are another three preconditions that make it very different. One is capital levels are much higher. So levels of financial leverage within the banking system are a lot lower. So a small change in assets produces a smaller loss than it did in 2007, 2008. And the second thing is regulation has meant that they have to be far more liquid. So before 2007, in 2007, 2008, they didn't run a lot of liquidity buffers. So they took a lot of risk. So the minute there was panic in the interbank lending market, a lot of people started failing. Whereas now the buffers are a lot larger, specifically in places like Europe. They're actual proper liquidity coverage ratios that are regulated in a far more stringent way. So we've got a safer system overall and much less of a problem. So I don't think that's going to morph into GFC2. I think we've got a few weeks of panic. A few banks are going to be resolved. Credit Suisse was a bank that had problems for the last 2 years. The minute this happened, their runway to restructure disappeared and they were resolved. So the authorities are being very, very proactive. So although it's scary, it's not that scary. And the second thing that's happened is it helps resolve the inflation problem. So one of the reasons the Fed doesn't have to do another 50 basis points is because the banks are going to stop lending as much. And that's tightening in and of itself. So all of this brings us closer to the end of inflation.
Do you think there's going to be an expectation, a comfort level with a higher level of inflation on average going forward, given that there's a deglobalization movement now coming on, and also there's peak kind of labor supply globally is now rolling over as well, kind of reducing? Is it fair to say that the higher inflation numbers, maybe above 2% that we've enjoyed in years past, the average now will be expected to be a little bit higher?
Yeah, I mean, so I think in the past we expected 2% as a reasonable number for inflation in the developed world. Okay, there are major reasons why that is as low as that. So one is demographics. When you have less people in the world, you have less demand over time. You might have less labor, but you've also got less people buying houses, less people doing stuff, less people spending money. That's structural. That's baked in to the cake. You've also got much higher levels of debt. So when you have high levels of debt, you don't have the ability to expand your balance sheet, borrow money and spend. So all of those two things, without doubt, keep a lid structurally on inflation. And then the third element is that we become far more innovative. As we've connected through the internet, our ability to innovate has gone up a lot, and most technology is deflationary. So if you think about almost everything you buy from a technological perspective, all it does is it saves you time, saves you money, and it costs less over time. So it's hugely deflationary. Those forces are not gone away. What has changed is two things, one of which is in our control and one which isn't. The one thing that's changed is that we're trying to go greener. So if you want to go greener, you go from low-cost hydrocarbons to high-cost renewables. And the cost works at two levels. One is the capital expenditure required to switch from oil to solar and wind is huge, or nuclear is absolutely huge. So that raises the cost of energy in the economy. But you can control how fast you do that. You don't have to go green in a year. And if we find that we're creating too much structural inflation that way, it'll be self-regulating. the price of the projects will be too high, the returns on the projects will be too high, and they'll just slow down over time. But that's definitely raised the core level of inflation in the world because it's going to cost more to produce energy. And then the last thing is, as you said, deglobalization. So we unfortunately moving from a connected world where we all trusted one another, where geopolitics was relatively benign, into a two-power race between China and the US. And we went from being competitors to now, potentially adversaries. And so what that means is that the trust levels of doing manufacturing in China or trading with China has dropped. So we're not going to have the benefit of their lower cost of production. And we're going to move supply chains closer to home. Now, that's not going to happen in every single line of business. Like, there's no reason to bring T-shirt production home. It's not a strategic problem, right? If we run out of T-shirts, we can very quickly work out how to produce them ourselves. We can't do that with semiconductors. And we can't do that with many industrial products that feed into our military, for example. So all that stuff's going to come home, but that's a smaller part of the economy. So there are going to be certain things where it costs more for a little while, but it's not broad-based. It's not every single thing. We're still going to be trading with China for a long time in many things that are not strategically important. So I think that, yes, that's out there and it's a nice headline, but if you look below the surface, there are a few things that matter. Many things don't. So to answer your question, if we went from 2%, if we move from 2% to 2.5% core inflation, that's a reasonable step up in underlying inflation. But 2.5% inflation is no biggie. The economy can run on that. We can grow it, nominal growth in the world is at least 4%. 2%, around 2%, 2.5% inflation, 1.5%, 2% underlying growth. If you're growing at 4% and you're financing yourself at around 2%, 3%, you can still finance yourself. You can beat that hurdle. It's just when your inflation goes above your actual ability to grow, and then the cost of money goes too high, that the financing cost overwhelms your ability to pay it off. That's when you have a problem. That's why the Fed has to get inflation down, because we can't live with 6% inflation, because as an investor, you'll need at least a 6% return, and you can't grow at 6%. So it just doesn't work. So you have to get inflation down. That's the logic of it.
Just on China and the reopening with a lot of pent-up savings, I think roughly there's about 2.5 trillion US in pent-up savings going to hit the global economy.
Yeah.
How's the portfolio position to capture that?
Yeah. So when we look across the world and we think about regional disparities, there's two things that look very obvious to us. One is China's been completely beaten up as a stock market for a number of years for a whole host of reasons. So it's actually very, very, very cheap on a long run basis. And the second thing is that China's reopening is going to unleash a wave of consumption the same way it did in our economies. In fact, they were locked up for longer and they save much more than we do. They have 30% savings rates. So the pile of cash there to be spent is huge, right? So we think consumption in China is going to pick up quite a lot. The government's underwriting the property sector. It doesn't want to have the kind of growth that it had in the past. It's levered up quite a lot and they've overbuilt property. So they're stabilizing that part of the economy. Exports will be a little bit slower, but consumption will be very significant in terms of the growth impulse. So Maotai, as an example, or listed in China, or LVMH, which we also own, which sells handbags to Chinese people, we think they're going to do record sales. So that's a part of the portfolio which we overweight. The second thing that happens with China expanding is that Europe as a bloc exports quite a lot to Asia. And so they'll get positive export growth, which will support a very difficult environment for them. Both those markets, Europe and Asia, are very, very, very cheap on a global basis. And if you look at that in comparison to the US, which is going to have a slowdown and is still expensive. So at the margin in our fund, we've moved more capital to Asia and Europe versus having capital exposed to the US, just as we play through the current dynamics.
For your basic philosophy, you said you're basically trying to buy the best businesses at attractive valuations.
Yeah.
And you often talk about the margins. So I guess the best business is the highest margins.
Yeah.
And then you said, but they're often mispriced or at low. Why do you think that is?
Okay, because I think that the market tends to be more short term. It seems to be long term, but actually, if you look at how investors behave, they look at 1 year forward earnings, 2 year forward earnings. But companies have 30 or 40 years ahead of them, right? So so if you just take a 20-year view, right, you're looking at 2 years as representative of 20 years. And oftentimes what happens is the strength of these businesses way outlasts people's ability or willingness to price. And so if you just get into them, even if you pay a high multiple for them and you write about the durability, you just go for the ride. You often find that if you held them for 5 years or 10 years, you way underpaid for them, even at 20 times multiple, because they just out-delivered people's willingness to price. But you have to be patient and you have to be very, very, very strict on what you buy and write that you're buying the high quality business. That's where the alpha from this comes. It's very different to value investing. Value investing is they look forward short-term, PEs, dividend yields, price to books, just next year's numbers. And if I get a good return over next year's numbers, maybe the business is people are a bit too pessimistic and I get a bit of a re-rating. So you have to keep reloading if you value, because value emerges and disappears, emerges and disappears, emerges and disappears, which is fine. It's a great investing style. There's another way of doing it, which is just getting to great stuff and staying it. And that works just fine too. It's just a different way, a different inefficiency in the market.
So just be mindful of time, just to see if any other questions that anyone would like to ask while he's here. In the interim, can you summarize in 3 key points the fund?
Yeah, I would just say, so as you said, buying the best businesses in the world. We have a very disciplined process in how we do this. I haven't gone through all the details of that, but I'm happy to do it. So it's very disciplined, consistent process. That's not shared by a lot of other fund managers. There's quite a lot of discretion in terms of how other people manage their product. We are truly global. So you can see we own some Chinese businesses. Not all global funds do that. And then I haven't spoken about it in detail, but we have a very, very robust risk management process. So one thing we look at is we look at clustering of risk in the portfolio, regardless of what it says on the tin. We look at how stocks behave and we try and smooth out risk clustering so that we don't have individual names destroy our returns. So we don't want high concentrations of risk. We want a good basket of 50 to 70 great companies that just deliver earnings growth over the long run for us. And we never want to, well, I say never, we prefer not to be first quartile. I don't want to be in the top. I don't want to be a first quartile fund manager every single year, because in order to achieve that, you have to take more risk than average. I'd rather be in the top half consistently and consistently beat the benchmark every single year. So you get a nice smooth ride and you earn the equity return that you can through this. So less vol than average. That's the aim of the fund.